Hi, we're joined today by UPGS, who have just announced their full year results. Thank you for joining us, Andy.
Pleasure.
Let's start out. It's been a tough year. It's been a tough year for all retailers in the UK, but I don't think it's been any different for UPGS. But you're starting to see an improvement and turnaround and move back to growth. How are you finding trading in the UK at the moment?
Well, it's a tough year in a tough market, and it's still a tough market, and it's going to be hard work all round. But yeah, the commercial teams under sort of Simon's leadership have gone out and made things happen. They've innovated, they've found new opportunities, and more importantly, we've stuck to our strategy. And as a result of that, we did have a decent finish to FY18, and the order book for FY19 is up on this time last year. Still early on in the year,
yeah.
And as I say, it is still a challenging market, but we're encouraged.
Excellent. And that's obviously UK sort of splits out between the discounters and the supermarkets.
Yeah.
Are you seeing, one area of particular strength amongst those two?
In terms of our order book, we're seeing improvements across our four pillars.
Yep. So
our four pillars of our strategy is discount, UK supermarket, online, and also international.
Mm-hmm.
So we are seeing growth in the order book across those four pillars, which is great. In terms of mix, we're seeing more international. Second half of FY18 was sort of 37% international,
yep,
as part of the overall sales mix. That's against sort of roughly a quarter will be the normal run rate for previous financial years. So and we're seeing something fairly similar with the FY19 order book as well. So circa 40% of the order book is international, and that reflects the efforts which we've put into targeting our international customers, and particularly Germany, where we opened a showroom in Cologne back in April.
Back in April,
Yeah.
and sort of how what kind of impact has that had on your ability to deliver for that market?
Yeah, I mean, I think what it does is people take you seriously.
Yeah.
If you're making a local investment, and we have also invested in local people. So we've got now 3 salespeople, one in place and 2 joining shortly. But we had been targeting that market before opening the showroom with some success. So we've got a number of large retailers there already open, with some of them already seeing repeat orders. Opening the showroom, it's another gear, and it's meant that I think that the local retailers are taking us much more seriously now.
And that's obviously for the German market. Is the showroom sort of having a wider impact on your EU strength? It
is, because Cologne is often where European retail goes. There's a couple of trade shows there which are European wide. I think also a number of the larger German retailers don't just have stores in Germany. Mm-hmm. They often have stores, particularly across Germany and Eastern Europe and the likes of Austria and Switzerland. So you open that door, you're opening wider opportunities.
Yeah. Okay. Excellent. Online, obviously, it's grown, albeit from a small base, but it is growing and has been something that you've been able to focus on and perhaps take control a little bit more of, rather than relying on your retailers. How's that gone in the last 12 months?
It's gone really well. Online, we didn't really do any online a few years ago, mm-hmm, because we didn't have the stock to do it. Yeah. As we become more branded, we've started to carry core ranges in stock, which has meant online is open to us as a channel. And therefore we saw 50% growth last year to £7 million of revenue. We're targeting sort of 25% growth a year, really, on an ongoing basis. Okay. We'd like to see it go to 20% of our overall revenue in terms of share. So we'll always be predominantly a wholesale business, but online and direct to consumer is now a big piece of that overall jigsaw. So we're really pleased with that.
Something you can use to trade yourself out of the tougher times.
Yes. Yeah.
So in terms of the brands themselves,
yeah,
obviously we've seen a relaunch of Progress in the last 12 months.
Yeah.
How much has that been a response to the tough trading conditions you've seen?
Well, I think what you see in Progress and Clean Easy are two good examples of how, you know, adversity brings opportunity.
Yeah.
We bought both those brands out of administration for very modest amounts of money. Progress is a brand that dates back to the 1930s. It's a Lancastrian heritage bakeware brand with a great story to tell. Clean Easy is nearly 100 years old as a brand, really well recognised. We bought Clean Easy for £100,000. We bought the trademark for £100,000 earlier this year. And we've relaunched both of them. Progress is further ahead. So we're already up to sort of 3 million of revenue on Progress. It's been very well received in Europe, and sometimes that happens, sometimes counterintuitive things happen. It's been very well received in Europe, and I think we may well be looking back in 18 months' time at a brand that is more European in its marketplace than the UK. Clean Easy is a good opportunity for us because it gives us options where bell dry isn't an option. So a lot of what we have to do is around channel management with customers. You know, you've got to be careful that you don't, you know, you're not selling the same product into customer A as you are into customer B if they're competitors. Yep. So Clean Easy gives us that option. You know, great story, 100 years old, British heritage brand. You know, I think it went through a lot of letterboxes in its time, so it's well recognised by the consumer. We've done the product rebrand. We've done the brand relaunch. So we've rebranded Clean Easy now. We're just in the process of bringing in some stock for it, and we expect to see it do well both in retail and online channels as we go forward.
I mean, you say you bought that out for $100,000 out of administration.
Yeah.
You see more opportunities like that come around.
It's an interesting. When they come quickly.
Right.
So you know, you have to move quickly. It's I suppose kind of part of our entrepreneurial DNA. We see a deal and we move. There might be one or two we're looking at the moment. Yeah.
Opportunities out there.
But it's got to be an opportunity. The thing about our business is everything has to be with an eye to cost, because we want to be at that mass market price. You know, so we can't go and pay millions of pounds for our brands because, you know, we want to be at a price just above own label. So these opportunities, you know, like, I mean, Beldray before it's now a 25-30 million pound brand. We bought that for less than £200,000 back in 2009. So it's part of what we do.
Yeah, the opportunity to move quickly and get a good deal for yourself and your customers.
Yeah.
Yeah. Obviously, part of making sure you can deliver for your clients is having the right staff in place. And I know you've been very keen to advocate your graduate programme. You know, how's that developing? Very
well. And, you know, we've continued to invest in our people. You know, it has been a sort of tough 12 months, I suppose, but we've continued to focus on the fundamentals of our business, including our people. The graduate scheme's been, you know, a great success. We launched it in 2012, and now, for example, we're starting to see some of those earlier joiners reaching quite senior positions. So, for example, our head of IT came through the graduate scheme, our head of housewares came through the graduate scheme, our head of online, our head of QA, and it's, you know, it's great to see. It's great, you know, it's great to see from a, you know, just from a personal point of view. But I think from a commercial point of view, it's great for building a culture within the business, you know, which is good for commercial reasons as well.
Yeah, low churn, good morality.
Yeah.
Great, thank you. Graham, thank you for joining us.
Thank you.
So last 12 months, obviously been tough, but you've traded your way through it. The lower revenue equals lower profit. There's nothing more complicated in it than that.
No, that's very much it, Hannah. It's you know, it's a disappointing year with the lower sales that we generated, but that was the whole driver of what led through to the lower EBITDA for the year.
Obviously, you're still sitting there though with a dividend which is 2-time covered and sitting there with a 7% yield at today's share price when I last looked. And in terms of the ambitions for the dividend going forward?
You know, the The 50% of underlying profits is our target or our intention for the dividend policy for the group. And we don't have a high capital requirement, so we'd expect that we'd be able to continue with that.
Excellent. And then in terms of the 4 sectors and the lower revenues across them, the 4 pillars, your 2 in the UK, discounters, supermarkets, online and international. Did you see any particular drop in any one of those categories?
The decline we saw was quite broad. It was generally across all areas, but within that we did see some positive areas. From the focus on Germany, we saw some good growth in Germany, up from 1.4 to 3.6 million, and then international as a whole in the second half we were starting to gather some good momentum. Growth of 16%, and share of sales had increased to 37% for that second half. And then the other positive is sort of online. We've continued to grow there with 50% plus growth in the year, getting to revenue at 7 million this year. And then also from the brand's perspective, Progress, it was its first full year and achieved revenue of 3.2 million, which is so we're pleased with that. Within the overall sort of disappointing results, there were some encouraging signs,
which are continuing now as
indeed, yes.
Yeah. Andy mentioned earlier that obviously the investment to open the showroom in Cologne. In terms of the capex on that, is that now done with?
That's all done. That's ultimate style is trying to keep it as low as we can. So that's. So the capex is done, and we've just got a modest rent on the property going forward.
And is there anything else we should look out in terms of big numbers that are going to be required going forward?
No, I think it's sort of pretty much as is really. We'll invest where we need to, where we see the returns and the opportunities, but no major changes expected there.
What about gross margin then? Over the past year and now as we move forward into 2019?
Well, I think there was a lot going on in last year. There were price pressures coming in the Far East. Currency is was and continues to be an uncertainty. Yeah. We have our hedging policy in place to cover that, but against that we mitigated with sort of continued innovation and product development, and customer mix changes helped us as well. So overall, our margin was broadly level with prior year.
Customer mix, can you expand
so
on that?
We tend to get a higher margin with certain customers or certain sectors than others, and as that change developed, and particularly from online, then that helped to mitigate the pressures that we've seen from the Far East.
Excellent. Obviously plenty of jitters about UK retail facing stocks at the moment. But how much has your strong balance sheet enabled you to weather this storm?
Well, I think our balance sheet remains simple. We've got some fixed assets, working capital, and then the debt to finance the working capital. And overall, our net assets increased by almost 2 million to 8.7 million last year. But more importantly, the headroom on our bank facilities finished the year at a higher level at 9.1 million.
Obviously, within that, though, your net debts have increased. It's still at a level that you're entirely comfortable with?
Yeah, I mean, net debt increased from 6 to 12.9 million, and the increase was wholly on our trade lines. So our trade lines are over 11 million at the year end, and that's activity driven. So within that, we saw an increase in debtors and the debtor funding that was required, and that was driven by increased invoicing in the last 2 months of the year, which is still in debtors. And then from the stock position, we've increased our stock by the year end compared to last year, but that's all there to fund growth that we've got in the Q1 order book for FY19.
And all stocked up and ready to go for Christmas?
Indeed.
Lovely. Well, thank you for joining us, Graham.
Thank you very much.
Okay, Andy, should we take a look at Outlook now?
Sure.
You've spoken to the strength of your order book across all 4 pillars. Obviously, traditionally we've looked a little bit more to the UK, which sounds like it is improving, but that alongside great growth in both international and online.
Yeah.
The focus is equally spread going forward?
Yeah, the order book is ahead of this time last year, but we are early on in the year, so you know, we must temper that. We still have peak ahead of us, but you know, we are encouraged by progress on the order book. It is across the 4 pillars. Overall, in terms of mix, international is still a growing share of that. So that's encouraging, given the investments we've made in particularly in our German showroom. So yeah, no, we're trading in line with expectations at this point, and we're happy with direction of travel. Good.
I mean, you talk about international, we can't escape the overhanging issue of Brexit.
Yeah.
No one has a crystal ball, but you know, what measures have you got in place to negate any impact?
Well, we aren't a business that imports and exports a lot from the EU. Our product comes in from the Far East and is all subject to WTO tariffs in the main. The bigger risk for us would be if there was a disorderly Brexit, is the impact on exchange. So we'll just have to watch that very carefully. We have a robust hedging strategy, which is you know, stood us in good stead over a number of years. In the event that we had a disorderly Brexit and we had cost pressures coming from currency in the medium to long term, we'd have to do what we've done over the last 12 months, which is innovate and reinvent our ranges and go again. That's all we can do.
Head down and trade out of it.
Exactly, yeah.
Online,
yeah.
So you mentioned earlier that you've got an ambition to get that up to 20%.
Yeah.
Is there any risk that your existing customers would see that as a sort of competition to themselves?
Well, channel management is kind of core to what we do, not just with online, but in our wholesale business. You know, we craft our offers so that, you know, as best we can, they're unique to that particular retailer. Yeah, with online, we don't want to compete with ourselves. We have to be sensible over pricing. We don't undercut our retail customers. That works well, and I think that's why I think we can take it to over 20% of revenue in due course. But we don't ever see ourselves as being a pure online retailer. Yeah. We will always be predominantly a wholesaler with a sizable online channel.
Okay, and of course all of that just builds to the resilience piece. You know, as you've pointed out, you managed to pick up brands like Chiellini's on the cheap, grow your online to help deliver some growth, and the international when times are looking tougher in the UK. As you look ahead, are you confident the business is well set?
It is well set, I feel. We are financially strong. We've got good balance sheets. We've got, you know, headroom within facilities. But I think more than that, our resilience also comes from our ability to trade out of challenging situations. It's not the first time I've seen this in 13 years, and it doesn't surprise me how the commercial teams, led by Simon, our CEO, have gone out there and made this happen. And I think not a lot of businesses can do that. You know, they don't have the flexibility of business model and the entrepreneurial kind of mindset that we have to deal with those challenges ahead.
Great. Well, thank you for joining us today.
Pleasure. Thank you.